Our today's topic is market efficiency and portfolio performance evaluation. We have four learning objectives today. So we will be discussing key principles of market efficiency. We will identify a different portfolio performance evaluation technique and among them the best one as a portfolio performance evaluation technique. And we will discuss evaluating the performance of a portfolio when the composition of portfolio changes. So the first learning objective is to review the key principles of market efficiency. A key component of an investment philosophy is your view of market efficiency. Therefore, to come up with an effective investment philosophy, investors need to understand the key principles of market efficiency and be able to form their own views of how market works and how efficient they are. So the question of whether markets are efficient and the degree to which they are or are not efficient is really central to portfolio management. It could believe that markets work very highly or close to perfectly efficient, then basically are suggesting that the market price is the best estimate of a firm's fundamental value, and in that case, the optimal investment strategy should be to diversify away and seek to maximize the transaction costs. Because if prices are equal to fundamental value, there should be very limited to no priced assets. However, if markets are not perfectly efficient, market prices might deviate from true value, and the process of valuation may be able to or estimate value that can be used to identify underpriced or overpriced stocks. Hence, market inefficiencies might provide the basis for screening the universe of stocks to come up with some subsample that is likely to be stocks that may be likely to happen on the market in future. So, three of these potential strategies to screen that we are going to look at throughout this course are momentum, value, and growth. There is a large quantity of academic research that suggests that each of these particular methods may have some merit in terms of identifying undervalued stocks using various mechanisms of screening. So let's go back to the principles of market efficiency and just recap what it's all about. We know that an efficient market is one where all information is incorporated instantaneously and without bias. Market prices therefore should be unbiased estimate of the true value of some investment. There are a few key aspects of market efficiency. While the market price should be unbiased estimate of true value, it does not mean that the market price should always actually equal to true value. It's just that any mispricing need to be random and unpredictable. So we are not necessarily stressing out that we need every asset to be perfectly priced. There is always going to be some noise in the stock prices as long as that noise is unpredictable and you can't profit from that mispricing, the market is still efficient. Market efficiency conditions also does not require that all assets have to have the same expected returns. This is another important point. The students sometimes think that if stock A has a higher expected return than that of B, then the market is not efficient. However, this is not correct. As we previously learned, expected returns should be a function of the risk of an investment and most particularly the systematic risk. Hence, all assets in order to generate the same utility are going to require different rates of expected return as compensation for different level of risk. So basically, what we should see is there should be a relationship between risk and return. Now, this is important because if you are screening the universe of stocks to come up with some subsample that you think is undervalued or you think might underperform, it's important that you identify that you had not just systematically screened based on risk and selected a subsample that just riskier than the rest of the market. It also should generate a higher expected return. It's also important that if one invests, let's say for example, often people point to Warren Buffett in this particular case, if one investor can outperform the market for an extended period, it does not necessarily mean that markets have to be inefficient. The reason for that is because let's say I get 1,000 people, and I can get 1,000 people to all pay a coin toss game 50 times over. Now, chances are that thousands of people playing a coin toss game with an unbiased coin 50 times, there is going to be at least one person who, just due to pure luck, be able to pick the way that the coin is going to land a lot more than 50% of the times. Equally, there's going to be the people in that group who pick the way that coin lands a lot less than 50% of the time. So just because in that 1,000 people, one person correctly picks which way the coins go to land more than 50% of time doesn't mean the coin is biased. The same can apply to financial markets. It is also possible that while some markets are efficient, others are not, and that a market might be efficient with respect to some investor, but not with respect to others. So market efficiency comes down to three key propositions. Number one is the probability of finding efficiencies in the market decreases as the ease of trading increases. So basically, you are going to be more likely to find mispriced assets where there is less trade. This is intuitive because the process which should maintain market efficiency and the process by which market prices should be returned to their fundamental value is arbitrage. Now, arbitrage opportunities are going to be very easy to exploit where there is quite a lot of trading. There's going to be a lot of people trying to identify and exploit those opportunities, so price should quickly be returned to its fundamentals. Now, if you have got an asset that's very difficult to trade or not traded very often, then you might find that few people will be watching the market and there might be constraints on arbitrage process. Hence, it's more likely that mispricing will be sustained in a relatively less liquid markets. Proposition number two, the probability of finding an inefficiency in a market increases as both transaction and information costs of exploiting the inefficiency increases. So not only does the level of trading in a market affects efficiency, but also the cost of trade. How is that? Because you might find a market like the property market. In the property market, for example, many people would argue that you can actually identify some houses that might be under or overpriced, or say some particular suburbs that might be under or overpriced. But the issue is that transaction costs associated with trading property are so exorbitant that the actual cost of exploiting mispricing are going to be greater than potential profits that can be achieved from exploiting this mispricing. So in that particular case, we have a market where mispricing exists, but it really can't be exploited. So that's a rationale for why those inefficiencies exist. Proposition number three, the speed with which inefficiency is resolved will be directly related to how easily the scheme to exploit the inefficiency can be replicated by other investors. If you have got some mispricing that can be really easily exploited, chances are that lots of people are going to replicate that strategy. Everyone is going to be in there trying to profit for themselves. As a result, the opportunity will disappear quite quickly. It's also important to note here the fact that a permanently inefficient market is actually not a good market for investors. Because the idea of identifying mispricing in a market that is less than perfectly efficient is the notion that you can identify stocks that are either under or overpriced. You could buy the underpriced or sell the overpriced, but the process of buying an underpriced stock does not guarantee your profit. Well, you generate your profit when the price returns to its fundamental value, and hence you can sell your underpriced stock for a gain. So basically what you need in terms of market efficiency is you need temporary inefficiencies where the prices return to equilibrium over the long run. If prices remains permanently out of balance, then you actually never be able to profit from that mispricing. So given that argument of market efficiency, given different perceptions around market efficiency, as I have said earlier, investors need to frame their own views on how efficient the markets are. One of the key arguments as to why markets are might be less than perfectly efficient is behavioral finance. So key notion underlying efficient market hypothesis is the view that investors are mostly rational. Even when they are not totally rational, the irrationality cancels out in aggregate. So there are no systematic biases. Hence, the market as a whole is not systematically acting any biasness. However, there is a large body of psychology research that points to the fact that human beings actually may have some basic systematic behavioral biases that affect the way we act, and this may filter into investor behavior within stock markets. So basically the idea of investment philosophy is most of them try to exploit one aspect of human psychology or investor irrationality or behavioral biases and try to exploit mispricing that might come about due to that particular bias. So therefore it might be important to understand what some of those behavioral biases might be. So some of common behavioral biases that have been cited in academic literature include, first of all, anchoring. Anchoring refers to the idea where we tend to be slow to update our belief systems, and we tend to hold on to past information or past beliefs even when it's irrelevant, when we're making decisions in the future. Another one is the disposition effect. It states that we tend to sell our winners too quickly because we want to lock in our profits. But we also tend to hold on to our loser stocks because we don't want to record a loss due to loss aversion. So what it means is we are basically selling off the good stocks that did well and holding on to the dots. This can have a negative effect on your portfolio performance, and this is argued to be one reason why we might see that momentum phenomena, which is something we are going to look at in a few weeks. Now, the common behavioral biases is that human tends to believe that they have got more ability than they actually do so. Particularly, investors tend to be overconfident. Now, unfortunately for the man, in the group research, it also tends to show that men are more overconfident than women. This is a behavioral bias that particularly affects the male gender. But you know, all humans in aggregate do tend to be more overconfident. We also see evidence of herd behavior. Humans tend to follow the crowd. So this one affects the way people participate in trading markets. Investors also might be unwilling or unable to admit their mistakes, which is another sort of behavioral bias. Let's just do a really quick experiment. Let's look at an example of a quick experiment. It shows how common some of these behavioral biases are. What I am looking at here is an anchoring experiment that was done in academic research. The first thing I want you to do is to write down the last 4 digits of your telephone number. Now, once you have written those 4 digits down, I want you to have a guess the number of doctors that licensed to practice in Newcastle. What the academic evidence tells us about this particular example is the idea of this experiment is that you even use irrelevant information upfront. If there is evidence of an anchoring bias, what we will find is that when people are making their best guess as to the number of positions in Newcastle, they actually anchor themselves or they use some of that past irrelevant information in terms of their decision-making process. So basically related to that, this series of questions are asked to a whole lot of our participants in an experiment, basically those people whose last 4 digits of their phone number were greater than 7. Greater than 7,000, their average number of doctors in Newcastle was about 8,000. Whereas those people whose last 4 digits of their phone number were less than 3,000, they gave an answer for the average number of doctors in Newcastle to be 4,000. Okay. So it provides evidence that the number you have written down, the last four digits of your telephone number, is influencing your judgment on how many doctors there are in Newcastle, even though these two bits of information are entirely independent and irrelevant for each other. So there is evidence across a range of different areas that suggests that human beings have these behavioral biases, and as part of their investment philosophy, if you do believe that markets are less than perfectly efficient, it's important that you can identify which particular bias you think have the most systematic effect and identify a trading strategy that can align with that belief. So this is the end of learning objective 1. Please watch the next video for our discussion on learning objective 2. Thank you very much.